So let's talk about the 6 keys to win more day trades. By the end of this video, you should be able to increase your probability of winning more day trades and become a consistently profitable day trader. And the way I like to think about these 6 keys is that each key is worth 10%. So if you're, let's just say on accident, if you do out of 10 trades, you win at least 1 out of 10. Currently, your win ratio is about 10%. So if you do each and all of these 6 keys, you should have the 1 plus 6, which should be a 70% win ratio as long as you follow these 6 keys, which will increase your probability. So let's go ahead and get started. Now, when you really think about this, it's a probability game, whether we like to admit it or not, when it comes to day trading and trading overall. So, how is it possible to consistently make money, considering how uncertain the stock market is? With that being said, now as a note to that, casinos make consistent money by viewing it as a numbers game, right? So when you think about it, what do you think the profitable 10% of traders do in the first place? It's essentially, okay, they basically have a plan and they execute the plan. But they have that plan because they've back tested the plan to know the plan's executable and able to function and be profitable. Just from maybe going in Thinkorswim, going in the on-demand platform and just testing it out and just doing years and years worth of data to see, okay, after doing years and years worth of data, it looks like if I do this exact thing at this exact point in time, it generally wins at least a 70% of the time, and I can make money doing this. It's not just what people go to do at the casino, which is have a beer and throw the money on the table and just throwing it down the drain. That's basically what most people are doing in the stock market world when they're day trading, when they're swing trading, when they're investing, because they don't have a plan. Most don't have a plan, but I do and we do if you follow my strategy. That's why a lot of my students are 70% plus consistently profitable. So with that being said, step number one. Step number one is to pick an option strike price that's closer to the stock price, whether it be at the money, one in the money, or one out of the money. So let's actually look at what that actually looks like. So this is a good example here. So where this little says entry here, I'm not going to get into the intricacies of exactly how to enter, etc. But there's an entry point over here as an example, just where the circle is. So the price over here at that point in time was about $451 for SPY. Remember, we only trade SPY specifically, and the entries and exits are on the 1 minute chart. So if that's 451, and let's just say as an example, we're going to go ahead and buy an option put with the strike price of $452 when we actually entered on the contract price itself of $1.24, so 1.24, and we exited literally only down here, right? So enter here, exit there. That exits at 1.43. The percent win on that is 16% of a gain on just these candles alone. Now, ignoring how large of a move that is anyway, if we go to the next one, the same exact play, but the strike price is much farther away, right? This is 449 of a strike price. The entry is so much cheaper, but it's 0.19, exit 0.21, and the win is only, quote unquote, only 11%. Now, maybe I'm blind, but if I go back, 16% of this move, just because it's closer to the price, versus this one over here, which is nowhere near it, right? It's not even on the chart over here, technically. It's a little farther down. It's 11%. So you win more trades if you can see profits faster. If you see profits faster, you'll be happy to exit out because you're like, man, I'm up 16%, or let's just say it gets from here down to here. Let's just hypothetically say it's 40%. You probably, I would imagine, would get out way before then because you're so excited because you made maybe 40% of your money. Versus, as an example, let's say the strike wasn't 449 and it was 430, something crazy. Well, heck, this move from here to here might be like 5%, right? So make sure to get something as close to at the money as possible and you'll make money faster. That's one key in the first place. So key number two is actually trade with the trend. This should be more obvious than it should be, but I have to mention it, right? Trading with the trend just makes sense. If the market's just simply going up that entire day, and if you don't know how to actually quote unquote predict if the market's going up for that specific day, watch some of my other videos actually on the channel, and I'll explain how that really works. But trading with the trend just logically makes sense. If the market's purely going up, find your reason to get into an option call and ride the thing upward. And again, as you can see, if we go back, not that long, technically, it's maybe for a few minutes, boom, 16% profit, get out, call it a day. right? But just trade with the trend. There's no reason if this is falling down right now, this is not necessarily going like any whether it be down or up. But let's just say the whole market at the whole day was just literally falling down, falling. Yes, there will be micro bounces and then it'll come back down. But why try to buy the dip for it to go up? If it's falling down, short it. If it's falling down, buy an option put. Don't be so picky that you want the market to say, "Oh, it's gone down so far. I know it's going to bounce." Maybe it's not. Who cares? Make money while it's going down because you can. But that's kind of step number two. That's key number two. If you follow the trend on a daily basis, and buying and selling on the same day, it makes your life so much easier. And a lot of people lose a lot of trades because they're going against everybody on the market. So keep it simple. Step number three is basically if you have FOMO, right? So the whole fear of missing out piece, that will absolutely destroy your account. Now the solution to that is very simple. It's literally just set an alarm, right? For me, when I'm trading, whenever I have my students with trading, anything along those lines, it's that if you can't handle looking at the screen, but you actually have a plan that you potentially want to enter on X trade, then set an alarm near that price, and once it comes back to that price, your alarm will go off. Then you can go ahead and potentially buy it. But I'm telling you, FOMO exists because you're watching the chart too much. And if you're watching the chart too much, you're going to start actually seeing things that technically aren't there. And then you're going to buy at the wrong time and potentially go against the trend, which is how that usually happens. So again, step number three, key number three, I'm telling you, if you have FOMO, you definitely need to get rid of it, and everybody needs to actually set an alarm, come back to your chart, and then trade only what you see at that point in time. Step number four really is around the whole discipline side of things. So you need to be firm with your rules and flexible with your expectations. So with that being said, one, you need rules. That's why my strategy specifically tells you, hey, you have a clear entry point. Let me take a step back actually. You only trade one ticker, which is SPY, the S&P 500. You only do same day expiration contracts. Let's say if it's Monday, Wednesday, Friday, right? Or next day expiration contracts if it's Tuesday, Thursday. So it's just that. You have a preset plan to say, I'm only going to enter the trade if it gets to X price, and then you have a preset plan to say I'm only going to exit if it gets to X price, or potentially break even if it's just not moving, right? Or potentially sell it at my stop loss, which is predefined before. But you have to be firm with those rules. Otherwise, you're going against the grain and you're going to basically lose because it's not proven to work if you go against the grain. But at the same token, be firm with the rules, but flexible with your expectations. So let's go back to it, right? As just with this quick example, if your plan was to sell down here at this little blue dotted line, and for whatever reason you bought here, it went down to maybe the bottom of this 1 minute candle here. It just never came down to tap it. It just started going sideways, sideways, sideways for 5 minutes. Get out of the trade. You got what, maybe 14 or let's just say 12% profit. That's fine. It's okay. Get out of the trade logically. You made money. You don't need these huge 100% gainers, please. And I'm not going to rant about that, but just get out of the trade. You made money. It's perfectly fine. So that's that. Be firm with your rules and flexible with those expectations. Now, number five is an interesting one that I know a lot of people typically have a big problem with, and it's basically that you need to avoid overtrading, and which also is similar to actually avoiding revenge trading. Because when you really think about it, and I'm not going to stick on this one very long, but all you really need is just one trade. That's it. And I mean one trade a day, maybe even a week. I challenge you, before I challenge you actually, leave a comment down below here on the YouTube video. How many trades do you take on a weekly basis? How many day trades do you take on a weekly basis? I'm telling you, when you think about it, if this is 16% of profit, how many of those do you really need a week to become successful? A lot of people, you can just do one. Maybe you could do one a day, I guess, if you want to. Maybe you do one Monday, one Wednesday, one Friday, or maybe one Tuesday, one Friday, whatever. But technically, you don't need to trade every day. So again, I'm just very curious. Leave a comment down below right now to let me know how many trades do you take on a regular weekly basis. But again, to avoid overtrading and revenge trading, just take as few trades as possible because quality makes much more sense than actual quantity. Forget about quantity. Just do quality trades. Now, last but not least is number six, key number six. Now, you need to take your actual hard earned profits out of the market on a daily basis and just run. Do not try to swing profits. If you say you're day trading a trade, day trade the trade. Don't a day trade can't become a swing trade. They're two completely different things, and the market analysis overall does not correlate per se, right? From a short end perspective. So if you made again 16% and it went to your take profit, you followed your plan, you were flexible with your expectations, get out of the trade. That's amazing. You made profit. A lot of people sometimes go back into the market and they give all their money back. So again, and if you've gone if you've had that issue, maybe let me know in the comment section below. How often have you maybe made, let's say, a couple $100 or $1,000 or plus, and then out of nowhere you made three, four, or five more trades, and you just look back at your P&L and L and you're like, huh, I guess I'm negative 2x of what I was profited at first. Like, how did I lose everything, right? It's because you, one, over traded because all you need is just the one, but two, you didn't take your hard-earned money and just run. So that's the 6 keys to basically becoming a consistently profitable day trader. And these, again, should increase your profitability. If you at least do one of them, I guarantee they work because they've worked for all the past hundreds of coaching students that I've had recently. So hopefully this helps, and I'll leave it at that.